denied.
That stamp? That's what's waiting for thousands of American homeowners who installed solar this year and don't even know it yet. You did everything right. You went green. You spent $30,000. You trusted your installer. And the IRS is about to hand you nothing. On July 4th, 2025, Independence Day, the government quietly signed away your energy independence. It's called the One Big Beautiful Bill Act. And if you haven't heard of it, that is exactly the problem. In the next 30 minutes, I'm going to give you ONE deadline, one trap to avoid, an ONE strategy that still works even after this law. Stay until the end, because the last section could save you $10,000. Let's start with a deadline that nobody is talking about.
If you want to stay ahead of the energy revolution and master the tech that's powering the future of the American home, do yourself a favor. Hit that subscribe button right now. Turn on the notification bell so you never miss a deep dive. And if this video helped you understand the new Tesla 420W panels, give it a like and share it with someone looking to go off-grid. Join the Volt and Vessel community. Let's future-proof your home together.
Let's go back to July 4th, 2025. Most Americans were at barbecues. Most Americans were watching fireworks. And while all of that was happening, a piece of legislation was quietly signed into law that fundamentally changed the rules of solar energy investment in this country. It's called the One Big Beautiful Bill Act, the OBBBA, and if your solar installer hasn't called you about it yet, you need to ask yourself why. Under the old rules, the Inflation Reduction Act of 2022, the 30% federal solar tax credit had a long, comfortable runway. Homeowners had years to plan, budget, and install. Businesses had time to finance, permit, and build. The government was essentially saying, take your time, we want you to go solar. That era is over. Under the OBBBA, the goalposts have been completely moved. If you are a commercial or utility-scale solar developer, your project must demonstrate that construction has physically commenced by July 4th, 2026. That is 1 year from the day the bill was signed. 1 year to break ground, pull permits, and put steel in the earth. And if you miss that date, you do not get a partial credit. You do not get a grace period. You get nothing unless your entire system is fully placed into service by December 31st, 2027. Those are the only two exits on this highway, and both of them are closing fast. Now here's where it gets personal. And I mean personal for the homeowners sitting in their living room right now wondering if they made a mistake. Because for residential solar, the situation is actually worse. The 25D Residential Clean Energy Credit, the credit that gave individual homeowners that same 30% back on their taxes, that credit officially sunset on December 31st, 2025. It is gone. If you did not have your residential system fully installed and operational before midnight on New Year's Eve last year, that 30% rebate is not available to you. Not delayed, not reduced, gone. I want you to really sit with that for a second, because the solar industry spent the last 3 years marketing that 30% number to every homeowner in America. It was on every billboard, every door hanger, every TV commercial. 30% back, 30% back. And now, the homeowner who signed a contract in January of 2026, thinking they were being smart, thinking they were being financially responsible, is going to file their taxes and find out the hard way that nobody told them the rules had changed. That is not an accident. That is an information gap, and that gap is costing real families real money. So right now, before we go any further, if you are a homeowner who signed a solar contract in 2026 and your installer told you that you would still receive the 30% federal credit, pause this video, pull out that contract, and read it line by line, because what they may have sold you and what the IRS will honor are two very different things. Now, for those of you who are still in the planning stage or who are in commercial development, there is still a path forward, but it requires you to move, and it requires you to move right now. That path is called Safe Harbor, and we are going to cover exactly how to use it before this video is done. But first, I need to tell you about the trap that is quietly disqualifying solar projects that look perfectly legal on the surface. It is called the FEOC restriction, and it might be the most important thing nobody in the solar industry is talking about. Alright, so now you understand the deadline. You know the clock is ticking. But here's the thing, even if you move fast, even if you break ground before July 4th, 2026, there is still a way your project gets disqualified. And this one is invisible. You will not see it on your roof. You will not see it on your invoice. You will only see it when the IRS sends you a letter telling you your credit has been denied. It is called the Foreign Entity of Concern Restriction, the FEOC clause, and it is buried inside the OBBBA in language so technical that most solar installers have not even read it yet. Here is what it means in plain English. Starting January 1st, 2026, any solar energy system that uses components, and I mean any components, panels, cells, frames, inverters, junction boxes, that were manufactured by or contain materials sourced from a foreign entity of concern, is completely ineligible for the federal tax credit. Zero, not reduced, not phased out, $0 on your return. Now you are probably asking, what exactly is a foreign entity of concern? The OBBBA defines it specifically. We are talking about China. We are talking about Russia. We are talking about Iran. And here is a number that should make every homeowner and every commercial developer stop cold. Approximately 80% of the solar panels currently being sold and installed in the United States today contain Chinese manufactured components. 80%. That means if you walked outside right now, knocked on the door of the solar company with the most trucks in your neighborhood, and asked them to show you their supply chain documentation, there's a 4 in 5 chance that their panels would fail the FEOC test under the new law. This is not a minor technicality. This is not something your installer can paperwork their way around. The IRS is not going to accept a certificate of origin that was typed up in the sales office. They want manufacturing documentation. They want component-level traceability. They want to be able to trace every wafer, every cell, every aluminum rail back to its country of origin. And if any part of that chain runs through a restricted country, the entire credit, every single dollar of it, is gone. Now let me give you a real-world example of why this matters so much right now. Think about the most common panel you see on rooftops across the country. The big brands, the ones with the slick marketing and the 25-year warranties. A huge percentage of those panels, even the ones with American brand names on the front, are assembled using cells that were manufactured in China or using polysilicon that was refined in China. The brand name on the panel does not tell you where the components inside that panel came from. And under the OBBBA, the brand name means nothing. What matters is the supply chain. So how do you protect yourself? You ask for something called a bill of materials. A real, detailed, component-level bill of materials that traces every part of your system back to its manufacturing origin. If your installer cannot produce that document, or worse, if they look at you like you just asked them for something unreasonable, that is your answer right there. Walk away, because the risk you are taking is not just losing a tax credit. The risk is spending $25,000, $35,000, $50,000 on a system and receiving absolutely nothing back from the federal government because somebody in your supply chain cut a corner you never knew existed. This is exactly why one product has become the center of so many conversations in the compliant solar space right now. The Tesla 420-watt panel, manufactured at the Gigafactory in Buffalo, New York. Made in America. Documented American supply chain. FEOC clean from cell to frame. Now, I am not here to sell you on Tesla specifically. There are other compliant options emerging in the market, and we will link some of those in the description below. But the reason Tesla keeps coming up in these conversations is simple. They have the paperwork. When your accountant asks for documentation, when the IRS asks for documentation, Tesla can produce it. That is not a luxury right now. That is a requirement. And here is the part that really stings. The panels that fail the FEOC test are not the bad panels. They are not cheap panels with poor efficiency ratings. Some of the most efficient, most affordable, most widely installed panels in America right now are FEOC non-compliant under the new law. Your installer may genuinely love those panels. They may have used them for years with zero problems. But loving a panel and being able to claim a federal tax credit on it are two completely different conversations in 2026. The solar industry built its entire growth model around affordability. Get the panel cost down, pass the savings to consumer. The tax credit covers the rest. The OBBBA just pulled the second half of that equation off the table for the majority of the market. And the companies that are going to survive the next 24 months are the ones who figured that out early and pivoted their supply chain before their customers started getting denial letters from the IRS. So before you sign anything, before you put a single dollar down on a solar installation, you need to be asking 3 questions. First, where were the cells in these panels manufactured? Not assembled, manufactured. Second, can you show me a component-level bill of materials with country of origin for every part? Third, has your company received any formal FEOC compliance certification from your supplier? If you get a confident, documented, verifiable yes to all 3 of those questions, you are in good shape. If you get a pause, a redirect, or a don't worry about it, that is the moment you pick up your things and find a different installer. Because the FEOC trap does not care how good your intentions were. It does not care how much you wanted to go green. It does not care that your installer seemed trustworthy. The IRS does not grade on effort. They grade on documentation. And in 2026, documentation is everything. So let's take a breath for a second. Because I know the last 10 minutes have been a lot of bad news. Deadlines closing, credits disappearing, supply chains under microscope. And if you are sitting there thinking, is there anything left? Is there any part of this industry that still makes financial sense after the OBBBA? The answer is yes. And it is sitting in your garage right now. Or at least it should be. I am talking about battery storage. And specifically, I am talking about the 48H standalone energy storage credit, the provision inside the tax code that covers home battery systems like the Tesla Powerwall 3, the Enphase IQ battery, and other qualified storage products. Because here's what most people do not know, and what most solar companies are not leading with right now. The OBBBA did not kill the battery credit. In fact, in a bill that dismantled or severely restricted almost every other clean energy incentive on the books, the standalone battery storage credit survived. And it survived with a runway that extends all the way through 2032. Let me say that again clearly so it lands. The 30% residential solar credit, gone as of December 31st, 2025. The commercial solar ITC on a hard deadline with construction requirements and FEOC restrictions. But the credit for standalone battery storage, the kind you install in your home or business to store energy, manage outages, and reduce your grid dependence, that credit is still alive, still at 30%, and still available to anyone who installs a qualifying system before the end of 2032. That is 6 more years of runway on a credit that the rest of this bill was busy dismantling. Now I want to be precise about the word standalone because it matters legally and it matters on your tax return. A standalone battery storage system means a battery that qualifies for the credit on its own. It does not need to be paired with a solar installation to be eligible. Under the old IRA rules, there was some ambiguity around this. Under the OBBBA, standalone storage is explicitly preserved. You can install a Powerwall 3 in a home that has no solar panels at all, and you can still claim the 30% federal credit on that system. That is a significant and underappreciated detail that changes the calculus for millions of homeowners. So what does that look like in real numbers? The average installed cost of a Tesla Powerwall 3 right now is approximately $12,000 to $15,000 depending on your market and your installer. At 30%, you are looking at a federal tax credit of $3,600 to $4,500 back on your return. For a 2-unit installation, which is increasingly common for whole home backup, you are looking at a potential credit of $7,000 to $9,000. That is real money. That is money that did not disappear on December 31st, 2025. And that is money that a huge percentage of homeowners are leaving on the table right now because they heard the solar credits are gone and assumed everything was gone. But here's where the strategy gets really interesting, and this is the part one I want you to write down. If you are a homeowner who missed a residential solar deadline, or if you are waiting on a commercial project that is still working through a permitting and FEOC compliance documentation, the battery credit gives you something extremely valuable right now. It gives you a way to take action, lock in a federal benefit, and position your property for the next phase of the energy transition, all without being subject to the July 4 construction deadline or the FEOC supply chain scrutiny that is hanging over the solar side of this market. Think of it this way. The storm hit the solar side of the roof. The battery side is still standing. And the smartest thing you can do while the solar market sorts itself out, while installers get their supply chain compliant, while the IRS clarifies its audit guidelines, while the dust settles on what projects can legitimately qualify, is to use this window to get your storage infrastructure in place at 30% back. Because when the solar market stabilizes and compliant panels become more widely available, you will already have a battery system in place. Your home will be storage ready, and you will have done it while the credit was still on the table. Now I do want to give you one important caution here, because I am not going to tell you this is completely without complexity. The battery credit under the OBBBA does have its own set of requirements. The system must meet minimum capacity thresholds, currently a minimum of 3 kilowatt hours for residential systems. It must be installed by a licensed contractor and placed in service at your primary or secondary residence. And while the FEOC restrictions are less aggressive on the storage side than they are on the solar side, they are not completely absent. Battery systems that use cells manufactured entirely by FEOC-listed entities may face partial restrictions in future tax years as the rules continue to evolve. So you still want to ask questions. You still want documentation. But the window is wider, the rules are clearer, and the runway is longer. The bottom line on batteries is this. The OBBBA gave the clean energy market a very rough July 4th, but it left one door open, and that door has a 30% sign on it, and it does not close until 2032. The homeowners and business owners who recognize that right now, who stop mourning the solar credit and start taking action on the storage credit, are the ones who are going to look back at 2026 as a year they made a smart move while everyone else was standing still. Coming up next, I'm going to show you exactly how to lock in that credit, and the solar credit, if your project still qualifies, using a strategy called Safe Harbor. And I'm going to show you what the IRS is specifically looking for in 2026 audits, because the rules have changed and the paperwork that worked 2 years ago will not protect you today. All right, you understand the deadline. You understand the FEOC trap. You understand that the battery credit is the one door that is still wide open. Now I want to give you the actual strategy, the one that tax attorneys and project finance teams use to protect their credits even when a project is not finished yet. It is called Safe Harbor. And in 2026, knowing how to use it correctly is the difference between locking in tens of thousands of dollars in federal benefits and losing them entirely because of a timing problem that had nothing to do with your intentions. Here is the core concept. The IRS does not require your solar or storage system to be fully installed and operational in order to lock in your eligibility for the tax credit at a given rate. What they require is proof that your project has genuinely begun. And they have two specific tests, two separate ways to demonstrate that your project has crossed the threshold from planning into reality. You only need to pass one of them, but you need to pass it with documentation that will survive an audit. Because in 2026, the IRS is not giving anyone the benefit of the doubt. The first test is called the physical work test. This one is exactly what it sounds like. You need to demonstrate that a significant amount of physical work has actually begun on your project. Not planning, not design, not a signed contract sitting in a drawer. Actual physical work. For a residential battery installation, that might mean the mounting hardware has been physically attached to your wall. For a commercial solar project, that might mean the racking system has been anchored to the ground, or the electrical conduit has been run, or the inverter pad has been poured. The IRS want to see that something real and irreversible has happened at the project site. And in 2026, they are being very specific about what counts. A truck showing up is not enough. A permit being pulled is not enough. Steel in the ground, hardware on the wall, wire in the conduit, that is what counts. The second test is called the 5% Safe Harbor. And this one is the one that more homeowners and developers need to understand right now, because it gives you a way to lock in your credit eligibility before the physical installation is even scheduled. Here is how it works. If you can demonstrate that you have paid or incurred at least 5% of the total expected project cost before the relevant deadline, in this case, July 4th, 2026 for commercial projects, the IRS will treat your project as having begun construction on the date that payment was made or incurred. 5%. That is it. On a $100,000 commercial solar project, that is a $5,000 deposit. On a $30,000 residential battery plus solar package, that is $1,500. If that payment is made, documented, and tied to a legitimate project agreement before the deadline, your construction start date is locked. The clock stops. Your credit eligibility is preserved even if the panels do not go on the roof until a month later. Now I need to stop here and give you a very serious warning, because this is a part of the safe harbor strategy that is being abused right now in the market, and it is the abuse that is putting homeowners and developers at serious legal and financial risk. The 5% safe harbor is not a paperwork trick. It is not a way to write a check to a shell company, call it a deposit, and tell the IRS you started construction. The IRS knows that. They have seen every version of that scheme, and the OBBBA gave them additional enforcement authority to pursue it. What they are looking for in 2026 is what they call continuous efforts, evidence that after the 5% was paid, the project kept moving forward in a genuine and consistent way toward completion. If you pay a 5% deposit in April of 2026 and then the project sits completely dormant for 18 months, the IRS has the authority to disallow your safe harbor claim entirely. The deposit was real, but the continuous effort was not. And that distinction is everything. So what does legitimate safe harbor documentation look like in 2026? Your tax attorney or accountant is going to want to see several things. They want a signed project agreement that clearly identifies the scope, the equipment, the timeline, and the total project cost. They want a payment record, a canceled check, a wire transfer confirmation, a credit card statement, showing that at least 5% of that total cost was paid before the deadline. They want evidence of continuous progress after that payment. Permit applications, equipment orders, installer scheduling confirmations, site inspection reports. And for commercial projects, the IRS has added a new requirement under OBBBA guidance. They want geotag photographic documentation of any physical work that has occurred. Not photos taken from the street, not stock images. Geotag photos with timestamps taken at the actual project site, showing actual work in progress. If your installer cannot provide that, or tells you it is not necessary, find a new installer. Here is something else I want you to understand about the safe harbor strategy that nobody talks about until it is too late. Safe harbor locks in your eligibility, but it does not lock in your credit rate automatically in every scenario. For commercial projects, there are continuity requirements, meaning the project must be placed in service within a certain time frame after the safe harbor date, or the locked-in rate can be challenged. Under the OBBBA framework, the general guidance is that projects using the 5% safe harbor should be placed in service within 4 years of the safe harbor date to maintain the strongest defensible position. That is not an absolute cutoff in every situation, but it is a standard your documentation should be built around. Do not let anyone tell you that safe harbor means unlimited time. It means protected eligibility for a defined window, and that window has to be used. Now let me bring this down to street level for a moment, because I want you to walk away from this section with something you can actually use this week. If you are a homeowner who is still considering a solar or battery installation in 2026, here is your action plan. Step 1. Find a FEOC compliant installer with documented American or approved supply chain equipment. Step 2. Get a written project agreement with a clearly stated total project cost. Step 3. Make a payment of at least 5% of that total cost before July 4th, 2026 and get written confirmation of that payment on company letterhead. Step 4. Keep every single piece of paper, every email, every text message, every permit confirmation that documents the progress of your project from that day forward. Step 5. Work with a tax professional who understands the OBBBA specifically, not just someone who did your solar credit 2 years ago under the old IRA rules. The rules have changed. Your tax professional needs to know the new rules. That 5-step sequence is safe harbor done correctly. It is not complicated, but it requires intention, documentation, and a timeline. And the homeowners and developers who execute it properly in the next few months are going to be in a fundamentally different financial position than the ones who waited, assumed, or trusted the wrong people to handle the details. The IRS is not your enemy in this process, but they are not your partner either. They are an auditor. And in 2026, with billions of dollars in clean energy credits on the line, and a new administration committed to scrutinizing every dollar of IRA spending, they are going to be looking hard at every safe harbor claim that comes across their desk. The only protection you have is documentation. And the time to build that documentation is before the deadline, not after. Coming up in the final section, I'm going to show you what happens when everything comes together, what a fully compliant, fully protected solar and storage installation looks like in 2026, and why the homeowners who get this right are going to be positioned for something much bigger than just a tax credit. Alright, we have covered a lot of ground in this video. You know about the July 4th deadline. You know about the FEOC trap. You know that the battery credit is still alive and breathing through 2032. You know how safe harbor works and what the IRS is looking for when they audit it. Now I want to bring all of that together. Because the point of everything I have told you today is not to scare you out of solar and storage. The point is to show you exactly what right looks like in 2026, so that if you choose to move forward, you move forward protected. Let me paint you a picture of what a fully compliant installation looks like right now. And I want you to notice every detail, because each one of these details corresponds directly to one of the traps we talked about earlier in this video. It starts with a homeowner. Let's call her Maria. Maria lives in a 4-bedroom home in suburban Phoenix. She has been thinking about solar for 2 years. She watched the IRA rollout. She heard about the 30% credit. She got 3 or 4 quotes, and then life got in the way and she did not pull the trigger before December 31st, 2025. So the residential solar credit is gone for her. That chapter is closed. But Maria is smart, and Maria watched this video. So instead of walking away from clean energy entirely, she makes 2 decisions in February of 2026. Decision 1. She contacts a solar installer who carries FEOC compliant panels and asks for their bill of materials documentation upfront before she even schedules a site visit. Decision 2. She moves immediately on a standalone Powerwall free installation to lock in the 30% battery storage credit while it is still available. The installer Maria chooses sends her a full component level bill of materials within 48 hours. Every panel cell traced to a domestic or approved international facility. Every inverter component documented. The paperwork is clean, organized, and formatted specifically for IRS review. Maria signs a project agreement, makes a payment that exceeds 5% of the total project cost, and gets written confirmation on company letterhead the same day. That payment creates a safe harbor date. Her credit eligibility is now locked, regardless of when the physical installation is completed. 3 weeks later, the Powerwall 3 is installed on her garage wall by a licensed contractor. The installer provides her with a commissioning report, a system specification sheet confirming the unit exceeds the 3 kilowatt minimum threshold, and geotagged installation photos with timestamps. Maria puts all of it in a folder, physical and digital, and sends a copy to her accountant. When she files her 2026 taxes, her accountant claims a 30% storage credit. Maria receives approximately $4,200 back on her federal return, and her home is now battery ready for the compliant solar installation that her installer is scheduling for late 2026. Once the FEOC certified panels are confirmed and the supply chain documentation is finalized. That is what right looks like. It is not complicated, but it requires every piece to be in place. The documentation, the compliance, the timeline, the professional guidance. Pull out any one of those pieces and the whole thing unravels. Now let me zoom out for a moment, because I think it is important to understand what is actually happening in the energy market right now, not just at the individual homeowner level, but at the level of the entire industry. Because the OBBBA did not just change a few tax rules. It changed the competitive landscape of clean energy in America in a way that is going to take years to fully play out. The companies that are going to survive the next 24 months are not the ones with the lowest panel prices. They are not the ones with the most aggressive door-to-door sales teams. They are the ones who built or sourced a compliant supply chain before the FEOC rules hit. They are the ones whose documentation can survive an IRS audit without a single phone call. They are the ones whose customers will still be receiving their full tax credits in 2027 and 2028, while the customers of less compliant competitors are receiving denial letters and hiring tax attorneys. And here is the broader picture that I want you to carry with you after this video ends. The energy transition is not over. It has not been cancelled. The OBBBA made it harder and more expensive and more complicated. There is no question about that. 1.6 million clean energy jobs are at risk by 2035 if the industry does not adapt fast enough. Thousands of projects that were in the pipeline are being delayed or canceled right now because the economics no longer work the way they were underwritten. That is real damage, and it is going to have real consequences for real communities. But the underlying demand for energy independence has not gone away. The utility bills have not gone down. The grid has not gotten more reliable. The climate has not gotten more forgiving. The reasons that drove millions of Americans towards solar and storage in the first place are all still there. And the homeowners and businesses who figure out how to navigate this new landscape, who get compliant, get documented, and get moving, are going to be in an extraordinarily strong position when the market stabilizes. Because here's what history tells us about every major policy disruption in the energy sector. There's always a shakeout period. The weaker players exit. The supply chains consolidate around the new rules. The financing structures adapt. And then the market grows again, usually faster than before, because the companies that survive the shakeout are leaner, more compliant, and more trusted. We are in the shakeout right now, and the investors, the installers, and the homeowners who understand that are the ones who are going to be on the right side of what comes next. So here's what I want you to do before you close this video. First, share this with someone who has been thinking about solar or storage and has not made a move yet. The information gap we talked about at the beginning of this video is real, and it is costing people money right now. Second, if you are in the 2026 planning window, do not wait. The July 4th safe harbor deadline is not a suggestion. It is a cliff, and the distance between the edge of that cliff and where you are standing right now is getting shorter every single day. Third, get a qualified tax professional involved early, not after you sign the contract, not after the installation, before. Because the OBBBA created a set of rules that require professional guidance to navigate correctly, and the cost of that guidance is a fraction of the credit you are trying to protect. And finally, do not let the complexity of this stop you from acting. I know this video covered a lot of ground. I know the law is complicated and the deadlines are tight and the documentation requirements feel overwhelming. But the path forward is clear. FEOC compliant equipment, legitimate safe harbor documentation, battery storage credit locked in now, professional tax guidance from someone who knows the new rules. That is the formula. It is not easy, but it works. And the families and businesses who execute it correctly in 2026 are going to look back at this moment as a year they made one of the smartest financial decisions of their lives. Thank you for spending the last 30 minutes with me. If this video gave you clarity, if it answered questions you could not find answers anywhere else, hit that subscribe button. because this is exactly the kind of content we are going to keep bringing you as the OBBBA rules continue to evolve and the IRS releases additional guidance through the rest of 2026. There are more updates coming, more deadlines, more opportunities for the people who are paying attention, and we are going to be here to break every single one of them down for you in plain English. The door is not completely closed, but it is closing. Move now